So this book called Bull came out, I think, in 2001 or 2002, about 17, 18 years ago, and actually was recommended by Warren Buffett. It's a really good book to read, written by Maggie Mahar. And what Maggie had chronicled in the book was she had looked at stock markets, and specifically in her case, she looked at the U.S. market over a very long period of time, like almost a century. And what she noticed was that, we are told that, for example, that if you had invested over the last 100 years in the U.S. equity market, you would have averaged about 9% a year, which is a pretty good return after inflation and such. But that's kind of a half-truth in the sense that markets go through very long periods where they do nothing, and equally long periods where they can be just spectacular returns, way above the 9%. And specifically what Maggie had honed in on in her book was, this is the chart of the Dow going back 1898. And so if you look at it, for example, when we, one period we can look at is like, for example, 1965. So the Dow was, about 870 approximately in 1965. And in 1981, it was again at 870. So, we went through a 17-year period, absolutely flat. I mean, it wasn't flat in terms of the market going up and down, but at those two endpoints, it was completely flat. So you didn't have a great result as an investor, even if you were very long-term oriented. And in that period, 65 to 81, the US economy grew a lot. So it wasn't like that the economy was in a bad shape or anything like that. Then you look at another period, which is 82 to 99, and the Dow went from less than 900 to more than 12,000. And the annualized return then was, well above 9%. We were doing about 15% a year. And so that, kind of was quite a spectacular period in terms of returns. And probably towards the early part of 2000, there was a lot of euphoria, especially because we had, at that time, we had all the craziness with the dot-com boom and the dot-com bust and so on. But even non-tech stocks got quite euphoric. And then if you fast forward from there, let's say from 99 or 2000 until around 2012, we're again flat. Pretty much there's no movement. And of course, it's not exactly flat because you went down a precipice in 2008 and 09 and then came back. But basically the 12-year period, we didn't have much to write home for equity investors. And then more recently, it's been kind of somewhat similar to the 9% average and such. And this is not a phenomena that is limited to the Dow or to the US. It's actually a global phenomena. So as you look at different markets at different times, and they don't obviously go through the highs and lows at the same times. They go through it at different times. But the reason we get these, and Maggie chronicled, there's a reason why we get these, specifically let's look at 17-year cycles, is about the length of human memory, if you will. So in 1965, the stock market was a very euphoric place. Valuations were stretched, and we had the Nifty 50 and all that sort of thing getting going at that time. And by the time you got to 1981, people would look at you funny if you recommended investing in equities. In fact, Business Week ran a headline at that time. In fact, they had to cover the death of equities. Basically, it's done. There's no point investing. And generally, when people are extremely bearish and they give up, they're just not interested at all, that sets up the foundations for a pretty significant bull run from there. So reason we get these cycles is that markets vacillate between extreme euphoria and extreme pessimism. And the reason they do that vacillation is because they're human-driven. And humans vacillate between fear and greed. And so as long as humans are driving the buying and selling of different asset classes, we will continue to have these cycles. And of course, as an investor, the value investor myself, this is kind of a weird kind of presentation for me to make because I don't pay any attention to macro anything. All my attention goes on figuring out a business and then figuring out what that business is worth and what that business might be worth in a few years and whether it makes sense to invest in it or not. And generally speaking, it's hard enough to figure out the future of one business. I think it's almost impossible to figure out the future of markets because that's just too complicated. But it is somewhat helpful, I think, to just understand a little bit about where we are in these cycles in different cases. And in my own case, Pabrai Fund started in July of '99, and I realized when it started that there were many elements of a bubble when I was getting going. And I also realized at that time, even though Maggie's book was not out then, that it was a terrible time to start a fund because I knew I'd be facing pretty significant headwinds because of these. But also the thing is the market was really interesting. So March 9th, 2000, I think is when the NASDAQ peaked. It peaked at a little over 5,000. And the day the NASDAQ peaked was the exact same day that Berkshire Hathaway hit a multi-year low. And literally people were pulling money out of Berkshire Hathaway and putting it into pets.com. And so that you had that phenomena going on. And so actually what I found when I started investing professionally was that there were lots of great opportunities, even in this overheated market, as long as you didn't participate in the euphoria. So all the money was going into a very small sliver of equities. And that small sliver was, going crazy. And so there were lots and lots of opportunities on lesser known names. And, people thought Warren had lost it. He wasn't in technology and all that sort of thing. And so actually the first year in Pabrai funds, for example, we were up north of 70%. And for the next several years after that, 2002, 2003 onwards, we actually did all positive returns, I think north of 15, 20% a year for a few years. And part of that was because I just focused on stock picking. And I had very little capital, and it was easy to find a few good ideas. So that worked. And but I think what was happening at this time, and I think if you take an example of something like Coca-Cola, for example. So Coke was selling in, I think, the early 2000s at something like 45 times earnings. And recently, it's been at about 15 times earnings. So basically, if you invested in the Coca-Cola company in 2000, from then till now, you've made like 2% a year. Not a great investment. The business has done really well. No problem with the business. But anytime you're buying at 45 times earnings and eventually that earnings number comes down to 15 times, you're going to have not such a great experience. So it's not enough to just buy great businesses. Price matters. And I remember I think it was in 2000, right when my funds had just started, I think been about a year or so, that one of my investors had been an employee of Microsoft. And in fact, he was one of the very early employees of Microsoft. He had retired from Microsoft, but with the stock options, et cetera, had done really well. And so he told me, listen, Mohnish, if you're ever coming to Seattle, I can introduce you to a bunch of Microsoft guys, and many of them may have an interest in putting money with you. And so I told him, as a matter of fact, day after tomorrow, I'm going to be in Seattle. What a coincidence, And so he said, oh, yeah, come on down, So, of course, at that time, I was, very happy to be raising assets, especially with someone saying, I've got a bunch of customers lined up for you. And so I visited Microsoft headquarters, and I met a whole bunch of folks, and some of them actually were, first 60 employees in the company and such. And of course, a number of them became investors. But I remember telling them at that time that, and I think they just thought I was some cheesy salesman saying this, but I told them that it was a terrible idea for them to be holding Microsoft stock. And they just thought, well, how stupid is this guy? Because all Microsoft had done until then had gone straight up, 30-40% a year for a long time. And the market cap, I think at the time, was over 600 billion. And I think eventually, it went all the way down to under 200 billion. And then, of course, now recently it's come. But even with Microsoft, from 2000 almost till just maybe 2013 or 14, you would have had almost no returns. And in fact, you would have had a rough ride because you would have gone down and then come up. So, and that wasn't even a dot-com, real business with real cash flows, but with very euphoric pricing. I think in 2000, Microsoft was making something like 10 billion, around 10 billion a year or so, and trading at 600 billion, and that math doesn't work so well. So if we look at the S&P over the same period, similar story, where we again go through these periods of flatline and such. So basically, if I just go back to the Dow for a second, 1965, extreme euphoria, 1981, extreme pessimism. Then you again get to 1999, 2000, extreme euphoria, and so on and so forth, and that will just continue. And if you look at it in terms of some other markets, I mean, the Nasdaq is a great example. Went through a 20-year period from 1980 to 2000, doing 20% a year, and then the ride from 2000 was quite a brutal ride because you went from 5,000 to 1250, 75% decline on a major index. This is not one stock going down, there's a whole index going down. And so we went 16 years, so it took the Nasdaq 16 years to come back, and that's with having Amazon and Apple and Netflix and all these high flyers in there. Even with all of that, it took 16 years to come back, and then more recently we've had a somewhat better ride. So we've had a similar situation. If you look at the Indian market, the Sensex, which is the kind of like the Dow in India, the Indian government actually liberalized the economy in 1992. Basically, India had a huge balance of payments problem, and they were running out of foreign exchange and such. So they opened up the economy. But even though there was a lot of growth that came from 92 onwards, for 12 years, the market was flat. And so we see the same kind of pattern of flat and then doing well. The German DAX, similar story. In fact, last 11 years is completely flat, no returns. And the the Japanese Nikkei is interesting because this was the mother of all bubbles. So 1990, the Nikkei peaked at 40,000. And here we are, 2019. It's been 29 years, and it hasn't come back yet. In fact, it's at about 50% of the peak level. So if you just think about even a company or an economy growing, 2-3% a year, 4% a year, some not that high a number, maybe 3% a year. I mean, in 25 years, things should double. Rule of 72. Here we are down to 29 years, and we have a negative return. And so 1990, Japan had a number of incredible bubbles, and one of the bubbles it had going on there was the mother of all property bubbles, real estate. In fact, the Imperial Palace in Tokyo was valued at the time more than all the real estate in the state of California. And in fact, when I read that, I found that incredulous. I just said, that's not possible. So I actually went and studied it. And I live in the state of California. I mean, we have phenomenal coastline, thousands of miles of coastline, and we have incredible real estate. And to have one small palace in the middle of Tokyo, and it actually exceeded the value of all the real estate in California, is just stunning. And of course, like our man in the pub with the 3 pints, the bigger the party, the greater the hangover. And they're not done yet. The hangover continues after 29 years. And so Japan is kind of interesting because the property bubble seeped into the equity markets, and it just took a long time. And in fact, if you look at the Japanese market today, the equity market's probably amongst the cheapest markets in the world. I think the one thing that dissuades me in terms of just generally looking at Japan is there is a culturally, Japanese companies do not put shareholders first. So usually employees are first, and then there are various other stakeholders that come after that, and shareholders are somewhere in the bottom. And so you find a lot of Japanese companies trading below cash. So if you just look at net assets, net current assets, and subtract all liabilities, and look at the market cap, basically they exceed market cap, which is basically Ben Graham era. But the issue is that the companies are not willing to let go of the cash, and so in some ways the cash, from my perspective, is an illusion, because to unlock that value, that cash needs to come out, and I don't think it's coming out. So that's an interesting market. Another one that is, I think, probably one of the most interesting is the Kospi in South Korea. And so if you look at the Kospi, actually, even though you see this 19-year period and then 2 years and 8 years, but if you take the entire period from 1989 to 2019, which is 30 years, basically what has happened in 30 years, the Kospi has gone from 1,000 to 2,000. So over a 30-year period, it's about a little over 2% a year. And if you think of Korea going back to 89, I mean, this is before the rise of Samsung and before the rise of Hyundai and before really the rise of South Korea as we know it today. So incredible growth, huge economic growth, and nothing in terms of equity returns. In fact, I'm making a trip next month to Seoul and Busan, and basically I'm visiting a few businesses. I have one investment in Korea, but probably one of the most fertile hunting grounds. Of course, the impediments are the language is an impediment, culture is an impediment, and such. But plenty of stuff trading at 3 times earnings and that sort of thing. And so if you want to go fishing where the fish are, I think this is where the fish are. And so these are some of the thoughts I just wanted to share in terms of and with equity markets we usually cannot tell for the most part where we are unless we get to extremes. When we get to extremes, then it's obvious. Like I think you can look at Japan and you can tell it's a cheap market. You can look at Korea and you can tell it's a cheap market. When I look at the United States, all I can tell is I can't find much to buy, but it doesn't mean things are overvalued. Just be they're either fully valued. Even if they're slightly above fully valued, they could grow into that. So I don't quite see signals one way or another in most of the markets. And most markets at most times don't get to extremes. They get to extremes at like once in 15 or 20 years and such. And then we can take advantage possibly if again within like the fact that Korea is cheap, all that means to me is, hey, maybe spend more time looking at Korean companies, but doesn't mean that I can obviously make an investment. If we can find businesses that we can understand within circle of competence, they're cheap and so on, then I think can look at them.